Dorothy. Okay. Right. Right. Okay. So today we are going to discuss the third lesson in advanced level accounting. Right. Generally, this is kind of like a fifth lesson, but I'll be taking it as the third lesson. So which is going to be the accounting concepts, right? So we are going to learn about the accounting concepts, right? Okay. Now we are going to learn about the accounting concepts, right? We are going to learn about the accounting concepts, right? Now before that, right, before we learn the accounting concept, what I'm trying to do is, right, there's a particular lesson in your grade 13 syllabus, right, syllabus called Conceptual Framework, called Conceptual Framework for Financial Reporting. Framework for Financial Reporting, right? So what we are going to do is, before we learn the accounting concepts, we will get a better understanding about the conceptual framework, right? Conceptual framework for financial reporting, right? So with that understanding on the conceptual framework, we will be able to have a better knowledge, a better foundation on accounting subject, right? Okay, so what I'm going to do is, the particular lesson is in your advanced level syllabus. It's like the topic number 5, right? Topic number 5, accounting concepts, right? Now, instead of discussing the accounting concepts, before that, I'm going to discuss the conceptual framework for financial reporting, right? Okay. So now we are going to discuss the conceptual framework for financial reporting, right? Now, if you look at the term here is saying conceptual framework for financial reporting. Conceptual framework for financial reporting, right? We will take this particular topic. We will try to understand the topic. This is kind of a theory area. So we need to have a better understanding, right? We'll take one by one. What is the meaning of financial reporting, right? Financial reporting. Financial reporting, the simplest meaning, this is about accounting, right? Accounting. Now in accounting, what we do is we report the financials, right? We prepare the financial statements and we provide them to the stakeholders for them to take decisions. So our task mainly is about preparing the financial statements and giving them to the stakeholders for them to make decisions, right? That is our main task. That is our accounting task, right? Now here we are focusing on, right, something regarding this financial reporting or the accounting function, right? So it's about accounting, right? Then you can see there are two words. One word is saying conceptual, other one is framework. So let me take the word framework here. Let me take the word framework, right? In Sinhalese we say Ramu, right? Akruti mein Ramu, right? Framework. Now, if you take the basic idea, now when you heard the word frame, right, you might think about a photo frame, right? Photo frame, right? So we have the photo, and covering it, we have this frame, right? So we have the photo, and covering it with, we have the frame. So frame is setting kind of like a limit, a boundary, kind of like a, you know, a set of margins where you can have the photo inside, right? නේ පින්තූර රාමුවට හයි වෙලා තමයි පින්තූරේ තියෙන්නේ. ඒකට පින්තූරේ රැඳිලා තියෙන්නේ රාමුව ඇතුලේ. Right? That gives kind of a boundary line, that gives kind of a, you know, a kind of a safety line, right? So inside which the photo is there. And taking that into consideration, think about a cricket match, right? Think about a cricket match. Now here we have the wickets and the players are playing, right? So in a cricket match, we know that cricket match is played inside the boundary line. Inside the boundary line, all the rules and regulations, everything applicable inside the boundary line. So the cricket match you plays inside the boundary line, right? So that now we are going to take these two things as a metaphor and try to understand what is a framework, right? We are going to learn something called framework for accounting, right? Now, when it comes to accounting, right? When it comes to accounting, there should be certain guideline, certain basis, certain origin for us to develop the accounting, right? Now, for us to have a, you know, for us to do a proper accounting, there should be a proper guideline, no? Right? There should be a proper guideline. There should be a proper, you know, the rules and regulations and the customs and everything. There should be a proper guideline, right? So this particular guideline is what we call this framework, right? So framework is kind of origin of accounting. Framework provides all the basis of accounting for you to do the accounting, right? The base is provided, the origin is provided through the framework, right? Framework. It's kind of like a boundary line inside which we play accounting. Accounting කියන ක්‍රීඩාව අපි සෙල්ලම් කරන්න ඕනි මේ framework එක කියන boundary line එක ඇතුළේ ඉඳලා. Right? Something like that. If you just think of it, right? And we are using the term called conceptual. We are using a term called conceptual. This framework, right? This framework is providing you the basic concepts which are relevant to accounting. Basic concepts which are relevant to accounting, right? So, මොකක්ද කියන්නේ? Conceptual. ඒ කියන්නේ අපිට concept එක, framework එකේ concept එක නිකන් frame එකක් වගේ ක්‍රියා කරනවා. For what? For accounting function. Now we are going to learn certain very important bases, very important concepts which are in accounting, right? So that is basically the origin or the foundation of accounting. Origin or the foundation of accounting, right? Okay. Right. Let me put that into another metaphor so that you can easily understand. Now, guys, if you consider accounting, to a house, let's say this is a house, right? Okay, right. This is the house called house of accounting, right? This is house of accounting. This is house of accounting. Now you can see the roof, you can see the walls, and this is the foundation. The foundation. Now, if we have a kind of a bird view or a helicopter view, let's say this is us, right? This is our eyes, we are looking, this particular house called the house of accounting. What we can see is the roof, right, on top, right? From the sky, if we look at a house, what we can see is basically the roof, right? Right? So basically this house is like your financial statements, right? If you take the accounting as a house, right, the top of that house, what we can see is basically the financial statements. You can see is financial statements. Now we can see this roof is built upon certain walls. So these walls are what we call the accounting standards. Accounting standards. Accounting standards. Accounting standards are the specific guidelines, to a particular type of a financial statement element, a specific type of an asset. For an example, property, plant, and equipment. How to account for property, plant, and equipment, the specific guideline is given in the accounting standard, LK 16, property, plant, and equipment. How to account for the inventory specifically. How we are supposed to account for the inventory assets specifically. That a specific guideline is given in an accounting standard called LKAS2 inventory. How to account for the revenue from the customers, right? One of the income mode is revenue from the customers. How we are supposed to income for the specifically for the revenue from the customers. That specific guideline is given by SLFRS 15 revenue standard, right? So like that, there are around 41 accounting standards. We are using them to prepare the financial statements. So financial statements are prepared on top of these walls called accounting standards. Accounting standards කියන බිත්ති මත තමයි මේ මූල්‍ය ප්‍රකාශ කියන වහලේ රැඳිලා තියෙන්නේ. Now, these accounting standards are developed based on the foundation for accounting. This is what we called conceptual framework for financial reporting. Conceptual framework for financial reporting. Conceptual framework for financial reporting. Now, these walls are built upon the foundation, right? The foundation, the base or the origin in accounting called conceptual framework. So conceptual framework provides basically the concepts as well as the objective of financial reporting. Now, based on these, you prepare the accounting standards. And based on the accounting standards, you are preparing the financial statements. So conceptual framework consists of a lot of concepts. It's kind of a broad guideline. Using this conceptual framework, you prepare some specific guidelines for specific type of financial statement elements, which is what we call accounting standards. Then using the accounting standards, you prepare the financial statements. You prepare the financial statements. Okay, right. Let me put it into another way, right? We'll try to find the link in our financial statement process. Where do we plug this conceptual framework into our process, right? When it comes to businesses, right, there are many interested parties, right? Many interested parties such as owners, lenders, right, customers, and employees, right? Now, all of them is what we called the stakeholders, right? We call them the stakeholders. The stakeholders are waiting to make economic decisions. They are waiting to make economic decisions about the business. For them to make economic decisions, what they need is financial information. Financial information. Financial information is provided through the financial statements. It's provided through the financial statements. So how do we prepare the financial statements? When it comes to a business, every day they are doing transactions. every single day the businesses are doing lot of transactions. There are loads of transactions. We initially capture these transactions through the source documents. So the document we issue as a proof for the transaction to ensure that the transaction has occurred. We issue a document. So that document is what we call the source document, right? So the transactions are then recorded in the source documents. Then these source documents are entered in the prime entry books. That is where we keep a complete record of the transaction and we classify the transactions. There are like 8 different types of transactions in general, where we recognize them in 8 different types of source documents, and then we record them in 8 different types of prime entry books. Okay, right. Then these prime entry books total, you record them in the general ledger. You record them in the general ledger. By using the double entry system. Right? You record them in the general ledger by using the double entry system. The totals of the prime entry books for which you pass the double entry, the debit and the credit, in the general ledger. Ledger is collection of information, collection of T accounts. Okay. Then by taking the summary or the closing balances of the general ledger, you prepare a document called trial balance. You're taking the closing balances of the general ledger and you're preparing the trial balance, right? Now all the details of detailed transactions, you have summarized them into a final document called trial balance. You have prepared the trial balance. Now you are using the trial balance to prepare the financial statements. You use the trial balance to prepare the financial statements. When you are preparing the financial statements using the trial balance figures, you need a guideline. So this guideline is given to you, right? This guideline is given to you by the accounting standards. Right? So CA Sri Lanka, Chartered Accountants of Sri Lanka is the authorized body to prepare the accounting standards, right? That power was vested to them by number 15 of 1995 Accounting and Auditing Standards Act. Number 15 of 1995 Accounting and the Auditing Standards Act has vested power upon Chartered Accountants of Sri Lanka to prepare the accounting standards. Accounting standard is a guideline. Which is given and which is being used to prepare the financial statements, prepare and publish financial statements. These accounting standards are prepared. By Chartered Accountants of Sri Lanka, referring to the conceptual framework, which is kind of like 38-page document. Right? This conceptual framework includes basically 2 things. One is objective of accounting and accounting concepts to a certain amount, right? So the conceptual framework includes the objective of accounting as well as concepts, right, in a broad nature. And using these objective and the concepts in the framework, you are preparing the accounting standards. And these accounting standards are kind of specific guidelines. You are using those guidelines, and here you have the information captured up to trial balance, and mixing them both, you are preparing the financial statements, right? Now these financial statements, in order to make a meaningful information, what you do is you analyze, right? And analyze information is given to the stakeholders for them to make decisions, right? Okay. So these financial statements, I hope you can remember, we have discussed earlier as well, right? The financial statements consist of profit or loss, statement of financial position, statement of changes in equity, statement of cash flows, and notes, right? So these are the 5 components of financial statements. The 5 components of financial statements are profit or loss statement, statement of financial position, statement of cash flows, statement of changes in equity, and notes and other explanatory information, right? And the financial statements are providing information about the 5 types of financial statement elements. 5 types of financial statement elements. These elements are assets, liabilities, equity, income, and expenses, right? So financial statements are providing information about the 5 elements: assets, liabilities, equity, income, and expenses. And you're putting them into 5 different formats: P&L, financial position, cash flow, changes in equity, and notes and other explanatory information, right? Okay. So that this is basically our accounting function, right? Now you can see where we can plug the conceptual framework in our process, So we need to understand that conceptual framework is pretty much an important area. I would rather say without the conceptual framework, we might not have a better accounting, right? So always remember the conceptual framework is kind of key, right? Conceptual framework is the foundation. Conceptual framework is the base. It is the kind of the origin in financial reporting, right? Okay. Now, what we need to understand is, guys, when it comes to stakeholders, there are basically 2 types of stakeholders now. There are certain stakeholders whom they have power, right? They have power, right? So basically, the stakeholders with the power are the management or the board of directors. So these management or the board of directors, they can demand for customized financial statements, right? They can ask for like special purpose financial statements. Now in the stakeholders, we have the management, no? The board of directors, the management, those who run the business, those who operate the business, those who take the decisions of the business, right? Now they have kind of like special power, no? They are the bosses, right? They are in the top layer of the business. So they can demand for like a tailor-made financial statement, right? The custom-made financial statement. Whatever their requirements, we can satisfy. So for these highly powerful people, the financial statements which you prepare is what we call the special purpose financial statements. But the other general stakeholders, right? Maybe the owners, maybe the lenders, right? Maybe the customers, maybe the suppliers, maybe the government. They don't have a specific power, right? Now, some of you might think, sir, why don't we take owner also into the special power? Not always, right? If you go to a sole proprietorship, owner and the manager both are the same. If you go to a partnership, owner and the management both are the same, but not specifically in a company, right? Company, the owners are shareholders and managers are a representative of those shareholders, may not be the exact shareholders. There can be some outsiders as well. So it's not always the owners are managing the business. So here we are looking at the management who has a special power, right? So because they are in the board, they are the ones who take the decisions. So they can ask for special purpose, a customized, a tailor-made set of financials. But all the others, right? All the other stakeholders, right? So for them, it's about, they're like general people. For them, what we prepare is what we call the general purpose financial statements. We call them General purpose financial statements. General purpose financial statements. Right? Now, what we need to understand is this entire conceptual framework is focused on what? General purpose financial statements, not the special purpose. Special purpose is to the people with that special power, no? So that is upon their requirement, on a their unique, whatever the requirement, they are preparing the financial. They are asking for the financials. But for other people, they don't have such power, no? So we have to give them a common set of financial, a general financial statement, so that anyone can use. So the conceptual framework is looking at the people with less power, stakeholders with less power than the management, because they cannot ask for a tailor-made financial. For an example, if you are a banker, you cannot ask for a tailor-made financial. For an example, if it is a supplier or a competitor or a customer, you can ask for a tailor-made financial. You have to go with the general purpose financial statements, right? So we are looking at the people with less power than the management. For them, we need to give quality information, right? So if you don't have that much of power, right, then you're supposed to receive a quality information. So we have to give that quality information to those people with less power, right? So that is the idea in this conceptual framework. Okay, right. Okay, right. So we will try to prepare a kind of a mind map, right, to get an idea of the conceptual framework. We will put it in a very, very simple manner so that you will be able to clearly understand the conceptual framework, right? So let me start from the center, the conceptual framework, right? So the conceptual framework basically focus on two things, right? Basically focus on two things. One is the objective, other one is about the concepts. So we are trying to discuss about the objective as well as the concepts, right? So starting with the objective, right? Starting with the objective, right? What is the objective of financial reporting, right? So we are looking at the general purpose financials. Now, objective of financial, objective of accounting or the financial reporting, right, is to provide, right, is to provide financial information to the stakeholders, is to provide financial information to the stakeholders. Here we are specifying basically three stakeholders: investors, lenders, and the other creditors, right? Those are the three critical stakeholders, and for them to make what? Economic decisions about provision of resources, right? So we'll put them into an order. The objective is to provide objective is to provide financial information to existing and potential investors, lenders, and other creditors for them to make decisions on providing resources, right? Now, the objective of financial reporting is to provide financial information. We are supposed to provide financial information. To whom? To existing, those who are in the business, those who have already committed in the business, as well as those who are willing to join, the potential, existing and potential. Investors, people who invest money in the business. Lenders, people who lend money to the business. Other creditors like suppliers, employees who provide their materials, who provide the labor, right? Other creditors. For them to make decisions, yes, they are always waiting to take decisions. Investors have to take a decision whether to invest or not. Lenders have to take a decision whether to lend or not. The suppliers need to take a decision whether to supply or not. Employees have to take a decision whether to stay or not, right? That they are waiting to take a lot of decisions. So in order to take these decisions on providing the resources, if it is investors providing money, if it is lenders providing money, if it is suppliers providing materials, if it is employees providing labor, they have to take decisions. Okay, right. Now, if you take this financial information, let me take this particular word separately. Financial information. What does it mean? Financial information means, right, information about the economic resources, right? Information about the economic resources of a business, right? Economic resources of a business, right? Now, what are these economic resources of a business? Economic resources are, in other words, these are the assets of a business. Assets of a business. Economic resources, in other words, are the assets of a business. Assets of a business. Right? Financial information means you are providing information about the economic resources. In other words, these are the assets of the business. And they are providing information about your commitments, right? Your commitments, your obligations, right? So let me put it like this. Your economic resources and your commitments, your commitments, right? Right? Your commitments, your obligations, right? Your obligations or your commitments. These can be divided into two, right? These can be divided into two, right? One particular type of a commitments are the internal commitments. These internal commitments are what we call equity. Internal commitments are what we call equity. Certain commitments are external. These external commitments are what we call the liabilities. Liabilities. So financial information means you are providing information about the economic resources. You are providing information about the economic resources. At the same time, you are providing information about the commitments, your entitlements, your obligations, right? Your internal and the external commitments or the obligations. Internal ones, we say the equity. External ones, we say the liabilities, right? Okay. Then they are going to provide information about the changes, right? They are going to provide information about changes in economic resources and commitments. Changes in economic resources and commitments. The differences, changes, right, in the commitments as well as the economic resources. Okay, right? Okay. Now, what are these changes in economic resources and changes in commitments, right? Changes in economic resources are, in other words, we say it's the revenue, right? Changes in economic commitments are the economic resources are the revenue. Changes in the liabilities is generally is what we say the expenses. Expenses, okay? Expenses, right? When there's a change in the asset, it will become generally a revenue. Change in a liability is generally an expense. Now, for an example, right? I had a debtor went up. Why debtor went up? Because I made a credit sale. So revenue. Right? My cash went up. Why my cash went up? Because I made a cash sale, a revenue. Right? In other words, the income. Let me better put the word income here. Right? So I'll put the word income. That's much better. Revenue is kind of like a specific item. Let me put that as income. Sorry. Cash goes up, then it's an income. My debtor goes up, it's an income. And liability goes up, generally it's an expense. How come? Salary payable increased because of the current month's salary expense. Electricity payable increased because of the current month electricity expense. Right? Another one, a stationery payable increased. Right? It's an expense. Okay? Right. Right. Then what we do is we take assets, we take equity, and we take liabilities together, right? And we prepare statement of financial position. We take income, we take expenses together, and we prepare the profit or loss, right? So taking assets, equity, and liabilities together, we prepare the statement of financial position. Taking income and expenses together, we prepare the profit or loss. To connect the P&L and the statement of financial position, we prepare the statement of changes in equity. We prepare the statement of changes in equity, right? Okay. So now you can see basically financial information is, in other words, are the financial statements. Statement of financial position, P&L, changes in equity, and the list goes on, right? Okay. So the objective is to provide financial information. Financial information is, in other words, the financial statements to existing and potential investors, lenders, and other creditors for them to make decisions on providing resources. So that is basically our objective. That is basically our objective of financial reporting. Right. With that, we are moving towards the concepts. There are a lot of concepts we are going to learn. Right, we are going to learn about a lot of concepts. We will take one by one, right? Okay. Let me take the concept of accrual, right? Let me take the concept of accrual, right? We are using the accrual concept. We are using the accrual concept to prepare the profit or loss and the statement of financial position. We are using the accrual concept in preparing the when we prepare the statement of financial position and the profit or loss. What does it say in the accrual concept? What does it say in the accrual concept? It's very easy, right? In the accrual concept, it says, right? Accrual concept, it says, right? A transaction shall be recognized. Accrual concept, it says, a transaction shall be recognized. A transaction shall be recognized as and when transaction has occurred, as and when the transaction has occurred, not at the point of cash receipt or the payment. Cash receipt or the payment. Right? Very easy. Right? So in the accrual concept, what does it say is you need to recognize the transaction as and when the transaction has occurred. As and when the transaction has occurred, we have to recognize the transaction. Don't wait until the cash receipt or the payment. Now, for an example, today I made a sale on a credit basis, right? I have done a sale to a creditor. He's my debtor, right? And he's going to pay me 1 month later. Now, today, of course, I have done the transaction. No? Transaction has already occurred. No? So I have to recognize that transaction today. I have to recognize that transaction today. I should not wait until 1 month later where I'll receive the cash. No. Since transaction has occurred today, you are going to recognize the income today. And you are going to recognize an asset called debtor. You are going to recognize an asset called debtor. and the debtor will be settled after 1 month, right? After 1 month. What we need to carefully understand is, because of the accrual concept, we create debtors, we create creditors, we create inventory, we create accruals, and we create prepayments. Because of the accrual concept, we create, right, the debtors, the creditors, accruals, prepayments, and even the inventory. Those are as a result of the accrual concept, right? So we are using the accrual concept in preparing statement of financial position, changes in equity, P&L, and even the notes, except for cash flow. Cash flow we don't prepare using the accrual concept. It's basically the cash concept. Okay, right. Now, after learning the accrual concept, right, we will learn few other concepts. Right? Okay. So let me take to this side then. Right. Let us learn a very important concept called qualitative characteristics. Let us learn a very important concept called qualitative characteristics. Qualitative characteristics. Right. Now, the conceptual framework is saying we are preparing these financials, the general purpose financials, to the general stakeholders. Right. So they don't have that much of power. Right. So whatever the financial statement we prepare, we have a duty. Right. We have a responsibility that those financial statement information is quality. We have a duty, we have a responsibility, right, to prepare a quality financial information. Otherwise, what will happen? If we prepare a financial information with, the quality is less, right? The financial information is not quality, then what will happen? For an example, it's a loss-making company. We converted it to a profit-making company, and we provided it to set of investors. Now, investors will totally rely on what we have provided, no? So they will invest in a business which is not worthwhile. They will invest in a business assuming it to be profit, but in reality, it's making losses. So end of the day, they might lose entire investment. And we might convert a loss-making entity into a profit-making company. And we might give that financials to a banker and ask for a loan. Now, the banker will also rely on our financial statements, and they will grant a loan. Now, we must always remember, bankers are providing loans out of not their funds. They are using the public funds gathered through the deposits. So the innocent public money, the money of the innocent public, you are giving them as a loan to a company, right? And the base is on information which is not quality information, right? It's a loss-making company. We converted to a profit-making company. So the banker has relied on a information which is lacking the quality. It's not quality enough, right? So that will create chaos, right? So sometimes the company might went bankrupt. The banker is not in a position to recover the loan. Then they are not in a position to pay for the depositors. The innocent depositors will have to suffer, right? So always remember, we as accountants, we have kind of a public duty to provide quality information to the financial statement users, right? Because they're totally relying on us, right? So then these qualitative characteristics is generally divided into two types. Qualitative characteristics are divided into two types, right? Let me take one by one. One particular type of the qualitative characteristics is what we say the fundamental qualitative characteristics. Fundamental qualitative characteristics. Other type of the qualitative characteristics is what we call the enhancing qualitative characteristics. One type of the qualitative characteristics are fundamental. The other type are enhancing, right? So we'll try to understand the meaning of fundamental and the meaning of enhancing. Fundamental qualitative characteristics means in the presence of the fundamental qualitative characteristics, it's a quality information. In the absence, it's not a quality information. Enhancing qualitative characteristics means in the presence, the quality will increase. In the absence, quality will decrease. Right? We have to clearly understand the two differences. Fundamental qualitative characteristics means in order to an information to be a quality information, in an information to be a quality information, fundamental QC is a must. Right? You need to have fundamental qualitative characteristics. If those fundamental QC are there, it's a quality information. Unless it's not a quality information. Enhancing qualitative characteristics means, right, it's not stronger like fundamental. It's not stronger like fundamental. In the presence of enhancing qualitative characteristics, the quality will increase. Quality will definitely increase. If those enhancing QC are not there, it does not mean it's not a quality, because fundamental is there, no? Right? It does not mean it's not a quality information. It's definitely it's a quality information, but in the absence of enhancing, quality is lesser. In the absence of enhancing, quality is lesser. Right? Okay. So with the presence of fundamental, it's quality or not quality. With the presence of enhancing, quality goes up. In the absence, quality comes down. Right? Okay. Now there are basically two types of fundamental qualitative characteristics. One is what we call relevance. One particular type is what we call relevance. Right? One is what we call relevance. Other one is what we call faithful representation. Faithful representation. One is relevance, other one is faithful representation. Faithful representation, right? Faithful representation. Okay. Now let me take what is the meaning of relevance, right? What is the meaning of relevance? Relevance means if an information can make a difference, if an information can make a difference in a decision, we say it's relevant. If an information is powerful enough to make a difference, right? Before receiving that information, you were having a different decisions. As soon as you got the information, that totally changed the decision. That totally changed the decision. Then we say that information is relevant. Then we say that information is relevant. Now, think for an example. For an example, let's say now you are trying to invest in a company, right? You are trying to invest in a company. You got company ABC's financial statements. You got company ABC's financial statements saying company is making profits, and this year they have made profit to a value of rupees 2 million. Company ABC in the current year, they have made a profit of rupees 2 million. They have made a profit of rupees 2 million in the current year, right? Now, you got another piece of information saying previous year you made a profit of 20 million. Previous year you made a profit of 20 million. This year only 2 million. And you're getting another piece of information saying your competitors have made a profit of 50 million during this year. ABC company last year 20 million profit, this year it has reduced up to 2 million. At the same time, the competitors are making thundering profits. Competitors are making a profit of 50 million rupees per annum. And they are performing well. Now, earlier, just looking at the piece of information saying 2 million profit, it may sound to you like that, okay, that's kind of a good investment. I should invest in this company. But when you receive the balanced piece of information that the profit has reduced compared to previous year, competitors are performing well than you, then your decision would change, right? You as an investor, you might think rather than investing in company ABC, I must go to the competitor. I must invest in that competitor's business. So that is more lucrative, right? That is more attractive. That may be giving me more benefits, right? So that piece of information change the decision, right? Okay, let me give you another example. Let's say you have provided the financial information to a banker, right? ABC company, for an example, has provided financial statements to a banker to obtain a loan. Right now, the banker is considering the eligibility to provide the loan. Suddenly, they got a piece of information saying, right, their loans are long outstanding. They haven't settled the existing loans. Those are long outstanding. At the same time, this company, out of their total assets, 90% are liabilities. And they have long outstanding loans. They haven't settled the previously taken loans. Now, if you are a banker, right, who is trying to give a loan, now the piece of information you just received will obviously change the decision, right? So that if an information is capable, if an information has the ability to change a decision, if an information is powerful enough to change a decision, we say, right, that information is relevant. We say that information is relevant. Okay, right. In order to be relevant, right, there are basically three subcomponents in the relevance concept, right? So one is what we call the predictive value. Other one is one we call the confirmatory value. And the third one, I'm going to take the materiality. Materiality. Right. The relevance have like three subcomponents. We'll take one by one. The first one is what we call the predictive value. The first one is what we call the predictive value. In order to be a relevant information, in order to information to be capable of changing the decisions, that information should have predictive value. What is the meaning of predictive value? Predictive value means you should be able to predict the outcome. You should be able to predict what is going to happen in the future. You should be able to predict what's going to happen in the future. If you are capable of predicting what's going to happen in the future, we say that information, right, is having the predictive value. Now, obviously, in that ABC company, when we got the information saying last year 20 million, this year 2 million, competitors 50 million. So what was your prediction? So my profit has come down from 20 to 2. Competitors are making, thundering profits. So obviously, based on this performance, right, I'm going to get lesser benefits in the future. If it is 20 became 2, 2 might become 0 in the next year, and going forward, I might be making losses. That was your prediction. That was your prediction. You thought you are going to make losses. What was the thought of the banker who was supposed to give a loan, right? So they saw that this company is highly geared. They have a lot of loans. They are tightened up with the loans, and their loans are long outstanding. They are not that settling the loans, right? So what gives that implication? So they are predicting if we were to give the loan now, we will not be able to recover the loan in the future. We will not be able to recover the loan in the future. So you predict what would be the outcome. So that is part of your relevance. Okay, predictive value. Predictive value. what is the meaning of confirmatory value? Now, in the predictive value, what we do is we are trying to predict what can happen in future. If we can confirm a previous prediction from an information, we say the information is confirmatory. Now, in the predictive value, we are trying to predict what might happen. If we can confirm it subsequently, right, with the information, if we can confirm them subsequently, we say that information has the confirmatory value. First of all, we are trying to predict what's going to happen, and we are going to confirm it with the subsequent information. If that can be there, we say it's confirmatory. Now, for an example, let's say there's a company who is making profits and there's an increase in trend. First year profit 1 million, second year 2 million, third year 4 million, fourth year 8 million, like that profit is increasing. So now we are predicting, okay, there's a growing trend, there's an increasing trend. So next year I might get 10 million profit, 12 million profit, 15 million profit I might get, right? So I might get 10, 15 million profits, right? So then you predicted the profit will increase and you're going to confirm it with the next year financials. Okay, I thought next year 10 million, what is the reality? Okay, 9.5, closer. Next year I thought 12 million, what is the profitability? 13. Okay, I have gone beyond my prediction. So you should be able to confirm, right? Confirmatory value. Confirmatory value. Okay, right. What is the meaning of materiality? What is the meaning of materiality? Right? Materiality means, right? Materiality means if an omission or misstatement, right? I'll take the two words, the omission or a misstatement, right? Omission or misstatement can influence a decision. Let me put it here. Materiality is where an omission or misstatement can influence a decision. We say it's material. We say it's material. We say it's material. Right? Materiality basically depends on both the size and the nature. Materiality depends on both size and the nature. Materiality depends on both size and the nature. Right. Okay. What is the meaning of materiality? If an information is omitted, if an information is missed, if an information is omitted, or if the information is misstated, ekko වැරදිලා අත්හැරිලා ekko අත්හැරිලා එහෙම නැත්නම් misstated වැරදියට දාලා. If it is omitted, you have missed it, right? Or it is misstated, you have put it in a wrong manner. If an omission or a misstatement can influence a decision, ඒක මත යම්කිසි බලපෑමක් කරන්න පුළුවන් නම් තීරණයකට, we say that information is material. Relevance is totally dependent on materiality. Materiality. And materiality depends on both size and the nature. Both size and the nature. Let me explain. Right. Now, for an example, let's say you are trying to invest in a company. You are trying to invest in a company which is making annual revenue of 1 billion rupees. This company you are trying to invest is making a revenue of 1 billion rupees. There's an error in revenue of rupees 10,000. This particular company has made a revenue of 1 billion rupees in this year. But there's an error. The value of that error is 10,000. Will you care about it when you take a decision? For an example, you are a potential investor. You are trying to invest in this company. Now you have been observed that there's a 10,000 rupee error, but you don't care, right? You don't care, but that 10,000 error, that 10,000 misstatement does not influence you because it's not that material. Size-wise, it's not material. So you're not bothered about it. You're not bothered about it. But if that revenue error is 100 million, if that revenue error is 100 million, now you will be bothered about it. If that revenue error is 100 million, Now you will be bothered about it. Why? Out of 1 billion, that means 1,000 million, 100 million is wrong. 10% of the revenue is wrong. Now you might think twice. Okay, revenue 100 million is too much, right? It's too much. It's too material. Okay, right. And always remember, material depends on the size and the nature. For an example, let's say a company has an inventory worth of 500 million. Inventory worth of 500 million. There's a fraud. There's a fraud occurred by the store junior executive. The junior executive in the stores has done a fraud worth of rupees 100,000. The junior executive who is working in the stores has stolen 100,000 worth of items. Right? Now, 500 million worth of items are there, you know, size-wise 100,000 may not be material. So you may not be bothered about that 100,000. Right? What if the same story, 500 million inventory, 100,000 worth of items were stolen by the director of a company? The director of the company, let's say the managing director of the company or the chairman of the company, has done that fraud, 100,000. Now, size-wise, you might think, okay, there is not that material, but managing director or the chairman is the top guy of the company, the top person of the company. If the top person is the top person is stealing stuff from the company, then we don't know what is happening in the other people, right? The top person should be having a very decent qualities and decent attitudes, right? He should not be a robber, right? He should not be a thief. If the chairman or the managing director is stealing stuff, that will give an indication about the company culture. So then it may be material, right? At the same time, for an example, another example I'll give you, right? For an example, let's say there's an error. The worth of that error is only 50,000, right? The company has, like a, revenue to the value of, let's say, 1 billion. So if 1 billion versus 50,000, we are not bothered about it. It's not size-wise, it's not material. But because of this error, let's say this company is a television company, and because of this error, they are about to lose their license. Let's say the government is very strict on a particular area, right? Because of this error, you are now about to lose the license. In such a scenario, 50,000 will become material based on the nature. Okay? Okay, so now we know the meaning of relevance. Okay, we look at the faithful representation. Faithful representation. Let me put it in a kind of a different color as possible. Let's say I'll take green, right? The faithful representation says, right, financial statements shall provide the real economic phenomenon of the entity, right? So the faithful representation, in simple terms, it says, right, the reality, the real economic phenomenon you are facing, the reality you are facing shall be presented in the financial statements, right? In simple terms, relevance means please say the important stuff. Relevance ke liye वैधागत देखिए. Please tell us important things, so that will impact our decisions. Okay. So what does it mean by the faithful representation? Faithful representation says you to say the truth at the end. What is the reality? What is the real economic picture? What is the real economic situation in your business? Tell that to the tell that in your financial statements. The reality, the real economic situation you are facing in the business shall be presented in the financial statements. Financial statements. In order to be faithfully represented, right, there are three things. Your financial statement shall be, one is complete, then it should be neutral, complete, it should be neutral, and it should be free of errors, right? So relevance is about saying the important stuff. Relevance කියලා කියන්නේ මේ important දේවල් කියන්න කියන එක, වැදගත් දේවල් කියන්න කියන එක. Relevance is asking us to tell important stuff. Faithful representation is telling us to say the truth. So in simple terms, fundamental qualitative characteristics says us to say the important truths. වැදගත් ඇත්ත කියන්නේ කියලා තමයි කියන්නේ. Right. Now we look at the faithful representation. So I told you the faithful representation is about giving the real economic phenomenon. The real economic situation you are facing shall be presented, shall be given in the financial statements. How we are supposed to do that? So for us to do that, my information shall be complete, right? The complete information, the revenue with the relevant expenses I have to provide. All the assets I need to provide. There can't be any hidden assets. I have to provide all the liabilities, right? I have to give information about all the liabilities. I should not be hiding liabilities. I should not be hiding assets. I should not be hiding revenue. I should not be hiding expenses, right? So the complete information shall be provided, right? The information, their explanation, the base, the policy. So you need to give a detailed information, not just the numbers. Numbers is the running. You have to provide the details, explanations, the basis, the theories, the assumptions. So those things you have to provide in a complete manner. Neutral. What is the meaning of neutrality? Neutral means information shall be unbiased, right? Information shall not be biased to anybody. Information shall not be biased to anybody. It should be unbiased, right? Now, obviously, when we are preparing the financials, guys, right? So sometimes there can be biasness, right? For an example, right? You are an accountant. You are preparing the financial statements. Suddenly, right? The chairman or the managing director or the finance director comes to you and say, look here, next year we are planning to obtain a loan. Therefore, this year financial should be lucrative. This year financial should be attractive. I don't know how, some way or the other, make it profitable and make a huge profits and show a better cash picture as well. Now somebody is, giving you certain instructions to do them a favor. So if you prepare the financials according to their requirement, you are having a biasness. It can't be like that. You have to be neutral. You have to be unbiased, right? For an example, once again, the general manager comes to you and say, look here, next year we are supposed to receive the staff bonuses. So the profit should be higher, right? So either increase the income, reduce the expenses, reduce the provisions, right? And some way or the other, make it profitable so that we can get a higher benefit as a bonus. Now, if we honor them, then we are becoming biased to the management, which is not right, which is not correct. Okay, which is not right, which is not correct. So what we should do is the financials shall be unbiased, right? It should be neutral. And you need to ensure you are not doing any mistakes. It should be free of errors. Now, always remember, when it comes to accounting, we can't be 100% perfect. That we cannot do, we never do. Why? In accounting, we are making a lot of accounting estimates, no? Right? We have to make certain estimates. Estimates are made based on our judgments. Estimates are not 100% accurate, right? So those are basic judgments, no? So free of errors does not mean you have to be 100% perfect. It means whatever the accounting, we not make any obvious mistake. We not make any, like frauds or whatever. Even though if it is an estimate where we are using the judgment, there should be a proper process, right? There should be a proper process. If you are following the process, if you are explaining that process in our financials, then it's okay, right? So always try to overcome errors as much as possible, right? So with a proper process, which is detailedly explained in the financial statements. So that is something expected under the faithful representation. Faithful representation, right? Okay. Right. So we have covered the fundamental qualitative characteristics, right? With that, we are trying to move on to the enhancing qualitative characteristics, right? Enhancing. Let me take it from here. I'll take it like this. Right. Okay. There are basically 4 enhancing qualitative characteristics. Let me put the 4 enhancing. Comparability, right? Verifiability, timeliness, and understandability. Right? There are 4 enhancing qualitative characteristics: comparability, verifiability, timeliness, and understandability. Right? We'll take one by one. What is the meaning of comparability? Comparability means if you can compare information and find similarities and differences. Similarities and differences. Comparability, right? Now, when we are taking a decision, obviously we are comparing it with another, right? You cannot just take some absolute decisions. No, it's always comparative decisions, right? So generally we are comparing our financial statements, right? Generally we are comparing our financial statements, right? Generally we are comparing our financial statements, right? Generally we compare either with the previous year or with the forecasted year, either with the competitor you are comparing or with an industry average. Right? So you compare, right? So before we take a decision, right? For an example, if you are an investor, you are supposed to invest in a company. You won't be looking at the current year profit only, no. You will be looking at the previous year profits, previous years of profits, whether there's an increasing trend, whether there's an increasing trend or a declining trend, right? You are comparing. or you are going to compare the target's profit versus the competitors. So we are targeting a particular company, no? You take the profitability of that company and you compare with competitors. Or you are trying to get an industry average. You compare. By comparing, you can identify what are the similarities. Okay, revenue-wise, both are same. Asset-wise, both are same. What are the differences? Liabilities higher and lower. Expenses higher and lower. You can identify the similarities and the differences by doing a comparison. So if you are able to compare the financial statements, then we say its quality is higher. Right? So in order to be a high quality information, that information should be comparable. Comparable with either own financials with the previous year or with the forecasted or with the competitors or with the industry. You should be able to compare. Without a comparison, you can't take a decision, right? So you should be able to compare. Right, that is one part of the enhancing qualitative characteristics. Right, we'll look at the verifiability. Verifiability means an independent, knowledgeable, observer's ability to reach consensus. Right. Now, verifiability means whether you are capable of verifying that information. Right now, I know set of information is provided in the financial statements. We have a doubt, no? We have a doubt whether it is true or whether it is a falsified information. It is truth or whether it is falsified information. So we have a doubt, right? So you should be able to verify. If we can verify, then we say the quality is higher, right? If we can verify, the quality is higher. For an example, how do we do the verification? Let's say the company has a revenue of 10 billion. Revenue of 10 billion is created with several ledger accounts. Ledger balances are created with the sales prime entry book. Sales prime entry book is prepared, sales journal. Sales journal is prepared with lot of sales invoices. And if we can dig deep into that invoice level, yes, true that, right? These lot of invoices have created the prime entry book. Prime entry book has created the sales ledger into trial balance, and we have prepared financial statements. If we can go to that population, if you can go to that consensus from a one figure, if you can reach to a document level, we say that information is verifiable. From a final figure to the source document, if you can have a reach, if you can have a trace, we say it's verifiable. That is what we say. The ability of an independent, knowledgeable observer. Ability of an independent, knowledgeable observer to reach the consensus of an information. Right? Ability of an independent and knowledgeable observer to reach the consensus. To reach the population of that information is what we say, right? Verifiability. Generally, these knowledgeable, independent observers, these are the auditors. This task is done by the auditors. Right? Okay. So now we know two of the enhancing qualitative characteristics. Timeliness. Timeliness says information shall be provided in time. It says information shall be provided in time. Now, in order to have a high quality in an information, you should receive that information in time. No, let's say the information is prepared, to the practically perfect manner, but it took 2 years, right? Now, for an example, financial statements were prepared, right, and you have done it on like a almost perfect manner, but it took 2 years to prepare that financial information. Now, 2 years later, when we receive the information, it's too late. No, we can't be taking a decision. No, right? The information shall be available, right, in time, not on time, in time, the sufficient time, right? Now, let me share one of the experience. There was a time I made an investment, and like 2 years later, I got the financial statements of that company saying the company is bankrupt. Right? Company is bankrupt. Now it's too late, right? I can't get rid of that investment. If I were to receive that information pretty early, I could have done something. Now it's too late. So always remember, right? The quality will definitely increase if you are receiving the information in time. Now that is why even in the Companies Act, it specifically says financial statement shall be provided within 6 months after the year-end date. After the year-end date, within 6 months, we have to provide the financial statements. Right? So that is coming from the Companies Act number 7 of 2007. So even the legally, right, they are putting the pressure that statement financial information shall be provided on time, provided in time. Okay. Right. Now, this does not mean that, let's say your financial year ends on 31st of December, right? Very next day, you just, get the information and you just prepare a set of financial and you provide them to the stakeholders. Right now, you just because of timeliness, you can't be providing the falsified information, no? Right? So always remember, right? Timeliness is a fact, but you need to ensure the financial information are effective, right? So ensure the accuracy and give it as soon as possible, right? Timeliness. Understandability. Understandability means, right, a person with a reasonable knowledge shall be able to understand, right? So understandability means a person with a reasonable knowledge. Now, for you to understand the financials, for you to read the financials, you don't have to be a chartered accountant. You don't have to be a properly qualified accountant. Right? You can't expect everybody to know the accounting terms. Right? Financial statements, financial information shall be understandable to a person with a reasonable knowledge. If you have a reasonable business acumen, financial acumen, you should be able to understand, right? So you have to prepare the financials in such a manner, in such a format that even a layman should be able to understand. Guy with the basic knowledge should be able to understand. So that is something you expect, right? So understandability means reasonable knowledge. A person with a reasonable knowledge even should be able to understand the financials, right? Okay. So this understandability, the timeliness, right, the verifiability and the comparability are the enhancing qualitative characteristics that will enhance, that will increase the quality of the information if it is present. In the absence, it will decrease the quality of the information. Okay. Right. So what you have learned is very important area, right? This is going to get tested most of the time. The qualitative characteristics. Qualitative characteristics. Okay. Right. So with that, let me move on to another concept. The basic assumption in preparing financial statements. Basic assumption. Basic assumption in preparing financial statements. Basic assumption in preparing financial statements. The basic assumption in preparing financial statements, there's only one, is what we called going concern. Is what we call going concern. The basic assumption in preparing financial statements is what we call going concern. Going concern. What is the meaning of going concern? The going concern says, right, it is assumed that business will continue for a foreseeable future period, right? In going concern, what we do is, it's an assumption, right? So the basic assumption, no, it is assumed that business is going to continue their operations for a foreseeable future period. Business is going to continue their business operations for a foreseeable future period. The simplest meaning is they are not going to close it down. They are not going to downsize it materially or curtail the operations materially, or they are not going to liquidate in near future. මෙයාලට කම්පැනි එක වහන අදහසක්, කම්පැනි එකේ ඔපරේෂන්ස් ප්‍රමාණාත්මකව කප්පාදු කරන අදහසක් නැහැ. ඒගොල්ලන්ගේ අයිඩියා එක කම්පැනි එක දිගටම කරගෙන යන්න. right? දක්නා අනාගත කාලයක් දක්වා. right? For the next number of years, they are going to continue the business. Right? With that assumption, we are preparing the financials. That is the basic assumption in financial statements. That you are going to continue the business. You are not going to close down. You are not going to liquidate the business. You are not going to liquidate the business. You are not going to close down the business. You are going to continue the business. Okay, that's what we say, the going concern basis. Going concern basis. Because of the going concern only, we classify the assets as current and non-current, right? We classify the assets as current and non-current because of the going concern. Because of the going concern. Okay, right. Are we clear up to this point? The concepts, right? We have discussed the accrual concept, the qualitative characteristics, and the basic assumption in preparing the financial statements. Okay, right. Okay, right. Then, under the conceptual framework, right, under the concepts, we are going to learn about the financial statement elements. We are going to learn about the financial statement elements. Right? These financial statement elements under which we will be learning financial statement elements, we will be learning the definitions, right? So that is given in the framework, right? The definition, right? The definitions. Then we are going to learn about the recognition, and we are going to learn about the measurement. right? The definitions, recognition, and the measurement. Okay, right. Definition, recognition, and the measurement. So this is kind of part of our conceptual framework, right? We are going to learn about the different types of financial statement elements. What are the definitions, and what is the recognition rule, and what is the measurement rule, right? So considering the availability of space and all, I'll move on to the next slide to discuss financial statement elements part. Okay, right. So this is basically part of our mind map, right? You should be able to get this into one page, right? Considering the adequacy of the space. Let me move to the next slide. Right. Okay. Right. So we are discussing the financial statement elements. Financial statement elements. Under that, we need to learn the definitions. We need to learn the recognition. We need to learn the measurement. Starting with the definitions. Definitions, let's say recognition and the measurement, right? So there are basically 5 elements. There are 5 financial statement elements: assets, liabilities, equity, then income and expenses. So let me put the items, right? Under the definitions, we got assets, we got liabilities, equity, income, and expenses. These are the basically 5 elements. Now we have to discuss about the definitions, right? Asset definition. Asset is defined as a present economic resource. Asset is a present economic resource. Present economic resource occurred as a result of a past event and which is controlled by the entity. Controlled by the entity, right? Now look here. Asset is a present economic resource. Asset is a present economic resource. What is the meaning of economic resource? Economic resource means the asset should be able to generate economic benefits, right? If you're having an asset, you should be able to generate economic benefits. What are the economic benefits? Economic benefits means inflow of cash, right? Outflow of reduction of an outflow of cash, inflow of any other type of an assets, like that. If you are at a benefit, if you are at an advantage, we say that's an economic resource. Now for an example, you have a motor vehicle. Is it an economic resource? Can you generate some economic benefits? Can you generate a cash flow? Yes. I can use the vehicle for delivery purpose. I can use the vehicle for rental purpose. I can sell the vehicle and earn something. So it's an asset, right? You are generating a cash flow. Okay, you are generating a cash flow. Okay, you are generating a cash flow. Okay, right? And right, economic resource is about your ability to generate the economic benefits. Another example, let me take a building. You have a building. You can sell the building at a higher value. You can use the building for manufacturing. You can use the building for office purpose. You can rent it out. So it's, yes, it's an economic resource. It should be present. Present means you should have it right now. If the vehicle was sold, it's not an asset. If the building is not yet purchased, it's not an asset. It should be something you have right now. Okay. So asset is something, a present economic resource, occurred as a result of a past event. The generation of asset, you are incurring the asset, you are creating the asset as a result of a past event. Vehicle was purchased couple of years back. Building was constructed couple of years back. Software was created 6 months back, right? So there's a past event which has created, which has developed, which has constructed the asset, right? And the third one, you should be able to control the asset. You should be able to control the asset. What is the meaning of control? What is the meaning of control? Control can cut. What is the meaning of control? Control means you are enjoying the economic benefits. Control means you are enjoying the economic benefits and you are taking the decisions, right? To say something is being controlled by you, the meaning is you should be able to enjoy the economic benefits and you are avoiding other people taking the same benefits. For an example, if it is your vehicle, you are using it, you are getting the comfort, you are earning the rental income, and you have the right to avoid other people enjoying the same benefits. If without your permission, if another person is renting out your vehicle, you can take actions, no? If somebody else is selling your vehicle without your permission, then you can take actions. That means you are controlling it. And you are taking the decisions, right? You decide where to, pump fuel, where to get the service done, where to do the repairs and maintenance, your decision, where to park, right? Nobody else is taking the decisions. If you can take decisions and you can avoid other people taking the decisions, we say you are controlling the asset, right? So in order to be an asset, these definitions shall met, right? Okay, we'll move on to the liability side. Liability is a present obligation as a result of present obligation as a result of past events, and the settlement will result in outflow of economic resources, right? A liability is a present obligation. Now you are obliged, you are committed, right? You have a responsibility, you have made a promise to other person, right? To somebody else, you have made an obligation. For somebody else, you have made a commitment, right? And it's present. It's not something which is over, right? It's not something yet to happen, right? Currently, you are committed. Currently, you are obliged, right? For an example, if it is a loan which is being paid off, you are not liable now. If it is a loan you are supposed to take, you are not liable now. If you are taken a loan, then you are liable. Right? It's a present obligation. It's a present obligation. As a result of a past event. What is a past event? Signing the loan agreement. Right? You're supposed you're having a liability towards your creditor, supplier. Right? You're supposed to pay him the credit figure. What was the past event? Purchasing items on credit. Purchasing items on credit. You're supposed to pay the electricity bill. What was the past event? Consuming electricity on credit. Consuming electricity on credit. Okay, right? So then, as a result of a past event, you have created a liability. Okay, and the settlement, when you are settling the liability, when you are trying to clear the liability, when you are trying to honor the liability, you may have to transfer economic resources. You may have to transfer, you may have to give the economic resources. What are these economic resources? Economic resources are the assets. When you are settling the liability, you have to use assets in the business. You have to settle the loan using the cash in the business. If the cash is not enough, you have to use other assets in the business. So if this is meeting, we say it's a liability. So it's a liability. Equity. Equity is the residual interest after deducting liabilities from assets. After deducting liabilities from assets. Equity is, in other words, asset minus liabilities. Right? Okay, equity is a residual interest after deducting liabilities from assets. Now, from the assets, we have to deduct the liabilities. Whatever remaining is belong to the owners. Now, for an example, there's a company, it got 100 rupee assets. Now, we can't say the entire 100 rupee belong to the owners, no. Of that 100 rupee asset, first of all, we have to settle the external liabilities. Let's say it's 60 rupees. Out of 100 rupee assets, I'm settling 60 rupee external liabilities. 40 rupee remaining is belong to owners, equity. Right? Okay. Basically, equity consists of two things. Right? Equity consists of capital and reserves. Right? Equity consists of capital and reserves. Right. So let's say we'll move on to the income. Income. Income means, let me put it here. Increase in equity in the form of increase in assets or decrease in liabilities without any contribution from equity participants. Right? So income can be defined as increase in equity. Increase in equity. Your equity has increased. Now, for an example, let's say I have made a cash sale, 100,000. Because of the cash sale, what will happen? Let me show it to you in another statement here. Right? For an example, let's say I have done a cash sale to the value of rupees 100, for an example. Now, because of the cash sale, one side cash asset goes up. On the other side, my revenue goes up. Revenue goes to my P&L, my profit or loss. And my profit or loss, my revenue goes up. That means ultimately my profit goes up. This profit will be then taken to the statement of financial position, and inside equity we have the capital, and I told you other one is reserves, your remaining profit. Because of this cash sale, revenue went up. As a result, the profit went up. That means your reserves will increase and the equity will also increase. Because of the cash sale, revenue went up, profit went up, reserves went up, and equity went up. So ultimately, because of this sale transaction, equity went up. Equity goes up. Yeah? Increase in equity in the form of increase in assets. Here, cash asset has increased. Cash asset has increased. Or let's say we are making the sale to a supplier. Supplier is saying us to, net it off against the liability. Instead of debiting the asset, we might put this to a, debit into a creditor. Abhi supplier kenek ithin liability set off karna kiyala hitan. So because of the revenue, now my supply balance is coming down. I'm selling to a supplier. So it can be a reduction of a liability, either increase in asset or reduction of a liability. And your equity has increased without any contribution from equity participant. If a owner has put some money, that will also increase equity, no? Now, without owner contributing, equity has increased because of revenue, right? අයිතිකාරයා සල්ලි දාන්නේ නැතුව වත්කමක් වැඩි වෙලා වගකීමක් අඩු වෙලා equity එක වැඩි වෙලා තියෙනවනේ ඒක ආදායම, right? That is an income. Okay, that is an income, right? So look at the definition of the asset, right? Definition of the income. So income can be defined as increase in equity in the form of increase in assets, so decrease in liabilities without any contribution from the equity participants. Equity participants, right? Let's see the definition of expenses, right? Decrease in equity, right, in the form of decrease in assets or increase in liabilities without any distribution to equity participants. Equity participants. Right? Now, if you look at the words here, right? Instead of increase, here we are using decrease. Increase, we are using decrease. Decrease, we are using increase. Contribution, we are using distribution. So it's compared from the income to expenses, it's matter of changing small amount of words. So what is the meaning of an expense? For an example, salary expense. Let's say salary expense, that will be debited to salary expense. My salary expense goes up. Let's say part is paid in cash, cash comes down, and part is payable. Let's say accrued salary or the salary payable. Now look here. One side, because of this expense, either asset went down or liability went up. It can be both even, right? And what will happen to the expense? then we'll go to the P&L. In P&L, your profit will come down because of the expense. Then you are taking the profit to the statement of financial position in equity. We got the capital and reserves now. Because of the profit comes down, reserves comes down, equity comes down. The salary in the form of either reduction of assets or increase in liabilities. Because of this expense, the profit came down in the form of reduction of reserves and ultimately ended up decreasing equity. We know that equity can reduce when we are making a distribution to the owner. It can be a drawing, it can be a dividend. As a result, even equity can come down. Here, without any distribution to the owner, without a drawing, without a dividend, equity has come down because of the expenses. Because of the expenses. Right. Okay. Right. So these are the definitions. These are the definitions of financial statement elements. Then how to recognize, right? When to recognize, right? When to recognize. Recognition is all about a timing. Recognition is about timing. When, right? Definition is what? What is this? Recognition is when are we supposed to recognize? When are we taking them into books? Recognition simply depends on two things. First one is it should meet the definition. First one is it should meet the definition. Before we recognize, it should meet the definition. It should be either an asset or income or liability or expense or equity. It should meet the definition. Second one, it should be a useful information. For us to recognize that, it should be a useful information. It should be a useful information. How to be useful? Useful means two things that we already know. In order to be a useful information, it shall be relevant and it shall be faithfully represented. These are the fundamental qualitative characteristics. If that information is relevant, if that information is faithfully represented, relevance means important, faithfully represented means truth. If it is an important truth and if it meets the definition, okay, now we can recognize. We can put them in our financial statements. We can book them, right? So this is the definition. This is a recognition criteria. If it meets the definition, if it is useful, it's high time for you to recognize, right? Okay, then we are coming to the end. The measurement is about at what value, right? At what rupee value we are going to measure, right? Here, when it comes to the measurement, there are two bases, right? There are two bases we are going to apply, right? One is the historical cost. One is the historical cost basis. Other one is the current value. One is the historical cost basis, other one is the current value. What is the meaning of historical cost? What is the meaning of historical cost? Historical cost, right? Historical cost means, right, actual cost incurred, adjusted to depreciation, maybe interest, right? Maybe impairment, right? Historical cost is the actual cost incurred. Now, for an example, I purchased a land 50 years back at 10,000, right? So that 10,000 is my historical cost, actual cost, right? So there can be certain adjustments depending on the requirement. Now, for an example, depending on the type of the item, right? For an example, let's say I purchased a photocopy machine. 2 years back, I purchased the photocopy machine for 1 million. I purchased photocopy machine at 1 million. I can use it for 4 years. So now 2 years have gone now. So that 1 million I have to reduce up to 500,000 because it's been depreciated. So that after depreciation value is historical cost, right? Now historical cost does not mean the original price you paid. You have to do the adjustments, depreciation, impairment, interest, depending on the type of the asset, you have to do the adjustments, right? So the historical cost is the actual cost incurred subject to certain adjustments, right? The current value you can take based on 3 methods, right? So one particular method is what we call the fair value. Another method is what we call the value in use. The last one is the current cost. Right. I'll give you the simple meanings. Fair value means simply it's a market value. Fair value means simply it's a market value, right? Right. What you do is you take, if the transaction were to happen with a market participant on a transaction day, what is the value we are going to either receive or pay? So basically the market value. You can't be doing a market value transaction with a related party, right? Someone you know. No, it should be totally different market participants, right? And you are doing the transaction on the measurement date. What is the value you are supposed to receive for that asset or value you are supposed to settle a liability? Simply, fair value is the market value. What is the meaning of value in use? Value in use means present value of cash flows. Right? Present value of cash flows. Now, when it comes to an asset, right, or maybe a liability, there can be cash inflows or outflows, right? Over the remaining number of years that you are going to use the asset or the liability, there are cash inflows and outflows now. Those cash inflows and outflows are future cash flows. Of those future cash flows, we eliminate the interest. Every future cash flow includes interest, right? We use a method called discounting. By using the discounting mechanism, the interest included in the future cash flows are eliminated, and you get the present value. Once you get the present value of the future cash flow, we say it's value in use, right? Present value. Okay, we will learn because that's kind of a technical thing that is we are going to learn in future. Finally, the current cost. Current cost means the replacement cost of an equivalent item. It's the replacement cost of an equivalent item, of an equal item. If you are going to replace the item with a similar one, what is the cost we would have incurred? If you are going to replace the item with a similar one, what is the cost we would have incurred? Is what we call the current cost, right? Okay, that means when you are measuring a financial statement element, you can keep the historical cost to incurred subject to certain adjustment, or you can bring that to the current value, the today's value. Either keep it in the past cost or today's value. Today's value means either the market value. If you are going to sell the asset, sell the item, what would you get? Or if you are going to use it, what is the present value of cash flows? If you are going to sell, what would you receive? If you are going to use, what is the present value of cash flows? Or if you are going to replace it with another one, what is the cost you would have incurred? So by using either of these values, you can bring that to the current value. Okay, or you can keep it at historical cost, right? So this is basically one part of the conceptual framework which discusses about the financial statement elements, the definitions, recognition, and measurement. What are these financial statement elements? When to recognize, at what value? Okay. Now, using these financial statement basics, right, what we do is we prepare the specific guidelines on specific type of assets using the accounting standards. So accounting standards are prepared using this broad base, right? If it is an asset, we take the definition, we take the recognition criteria, we take one of these, one or two of these measurement methods, and we prepare a standard. That is how it works. Okay, right. So the financial statement element part is connected to one part of this conceptual framework, right? And there are few other things inside the conceptual framework which may not be part of your syllabus, like the capital maintenance, right? So apart from that, today's discussion, we have completed a very thorough, a very summarized, and in that summary we went on to a lot of details, right? Detailed discussion on conceptual framework, which is the basis, which is the origin, which is the foundation, without which we can't do accounting. Okay, right. So you have the tute, and the detailed explanations are there in the tute as well, right? We can always refer the tute, and we will do the questions related to this area next week. Okay, right. So with that, we can conclude on conceptual framework for financial reporting. Right. Okay.